Okay, let's talk a few minutes about costs. Now, costs are huge in managerial accounting and for businesses because they have to understand their costs so they can price their products appropriately, so they can ensure ultimately that they're going to make a profit. And good control and a good understanding of costs is fundamental in this process. So there's two primary types of costs that we can have. One is called a direct cost, the other is called an indirect cost. Now, a direct cost can be easily associated and cost effectively traced to a cost object. Now, you may be wondering, what exactly is a cost object? It's going to be anything for which managers need a separate breakdown of its component costs. So some examples of cost objects may be a product or a department or a sales territory or any type of activity. And if we're talking about manufacturing, we're usually talking about a product, a specific product. Now, indirect costs, on the other hand, cannot be easily and cost effectively traced to a product. For example, the salary of a production supervisor is an example of an indirect cost. The production supervisor manages the factory operations for all of the products that the company manufactures, so it's hard to trace directly the cost of the supervisor to a specific product. And we'll talk more about those here as we go along. Now, let's compare merchandising and manufacturing companies. So a merchandiser buys a finished goods and they sell them. So they just buy something that's ready to go and they turn around, mark it up, and sell it. Manufacturers, on the other hand, they buy raw materials and they have to convert those raw materials into finished goods before they can actually sell them. Now, there's some fundamental cost concepts here with manufacturing that I'd like to talk about. Now, I mentioned a minute ago that manufacturing consists of processing raw materials into finished goods. So the raw materials are going to be the basic materials and parts that we use in our manufacturing process. Now, manufacturing costs are typically classified as to one of these three: direct materials, direct labor, or manufacturing overhead. So here's a really important concept that you may want to write down. And basically what it says is your total manufacturing costs. You may find problems or questions that relate to this. So total manufacturing costs are going to be equal to your direct materials plus your direct labor plus your manufacturing overhead. So again, total manufacturing cost equals direct materials plus direct labor and manufacturing overhead. Let's look at each one of those components in a little bit more detail. So direct materials are raw materials that are going to become an integral part of the finished product whose cost can be conveniently traced to it. Great example here is a car. Everybody's familiar. It says a radio. So you can think of all the parts and pieces that go into building a car, and all of those would be considered direct materials. You've got tires, you've got wheels, you've got lights, you've got steering wheels, engines, seats, all those different types of items. Now, indirect materials are raw materials that cannot be easily associated with a finished product, and those are considered part of manufacturing overhead. You may think about when you go to get your car serviced, and they often will include a line item for miscellaneous shop items. So perhaps lubricants or towels that they need to do maintenance. All that would be considered manufacturing overhead. I actually like to use the example of Rice Krispie treats in the classroom. So our direct materials, if you think about when you make Rice Krispies, would be your Rice Krispies, your marshmallows, and your butter. And then the indirect materials here would be maybe your spray pan that you spray to coat the pan so it doesn't stick, the spray butter, or maybe some dishwashing detergent, something like that. In essence, the indirect materials are just product that's not necessarily, either it can't be easily traced or associated with the finished product, or it's not necessarily part of the finished product. Or in general, it's just insignificant and part of terms of the product. So if we're building something and it's 0.2022 cents, maybe it's just not worth tracking for the sake of cost. So we'll just lump it into this direct materials. Now, indirect materials are considered manufacturing overhead. Let's look at labor here. We have two types of labor. We have direct labor and indirect labor. So if you can imagine, direct labor are for employees whose work can be physically and directly associated with converting raw materials into finished goods. So if you have someone on an assembly line, you know they always work on a particular product. We could go ahead and use that as direct labor. Now, what if indirect labor? We have factory employees who have no physical association with the finished product, or for which it's impractical to trace those costs. A good example would be maintenance. Often you'll have maintenance people working in a factory who may work on equipment for multiple products, and it's very difficult or even impractical in that sense to track their labor as it relates to a specific product. It might be possible, it's just not practical, so we don't bother and we'll throw that in. Now, indirect labor is also part of manufacturing overhead. So manufacturing overhead is just in general costs that cannot be traced directly to specific units or products. So some examples up here: depreciation on equipment and factory machines, insurance, taxes, maintenance on factory facilities, indirect labor, and indirect materials. So examples might be maintenance workers, janitors, security guards. Again, they're involved and their costs count as far as a product is concerned, but we can't necessarily track it to one particular specific product. And then when we talked about indirect materials, examples would be lubricants, cleaning supplies, etc. So let's do a quick review. Oh, you've already got the answer. Alright, so the question actually reads, which of the following is not an element of manufacturing overhead? And it's even a little bit highlighted, so that's kind of like cheating. But the answer would be sales manager's salary. It's not an element. Sales has nothing to do with manufacturing, so you'll see here in a minute that's not related. The other three would be part of manufacturing overhead: plant manager salary, factory repairman's wages, or product inspector salary. Again, these are kind of vague and difficult and hard to trace. Here's another review. It says to determine whether the following are classified as direct materials, direct labor, or manufacturing overhead. So you may want to pause the slide for a minute and see if you can figure out what each one of those should be, and then I'll show you the answers here. A windshield and engine, those are direct materials. Direct labor, wages of an assembly line worker. Manufacturing overhead is depreciation of the factory machinery and factory machinery lubricants. Tires and a steering wheel are obviously direct materials. And then manufacturing overhead, salary of a painting supervisor. Okay, well, we talked about those costs already. Let's look at prime and conversion costs. So direct materials and direct labor added together are referred to as prime costs. So again, something you might want to write down. So prime is your direct materials, we'll abbreviate, plus your direct labor. Then we have something called conversion costs, and that is your direct labor plus your manufacturing overhead. Now, your manufacturing overhead, remember, is going to be your indirect materials, your indirect labor, and other indirect types of costs like taxes, insurance on the building. Okay, so we have more costs now. Let's discuss the difference between period and product costs. Period costs are expensed in the same accounting period in which they're incurred, and selling and administrative costs are a type of period costs. Now, product costs are costs of purchasing or making a product. So the costs are first recorded as an asset in the inventory account, and then for merchandisers, there's only one inventory account. For manufacturers, we have a raw materials inventory. We also have work in process inventory and then finished goods inventory. So we have three categories of inventory for a manufacturer. And then once the product is sold, the costs are expensed to cost of goods sold. So again, those three, and I'll write them down for you here. Those three types of inventory for a manufacturer are raw materials, work in process, so that's work that's been started but not yet been completed, and then finished goods. And interestingly enough, the inventory will flow from one to the other. So once we take some raw materials and move it into work in process, we add a little labor to those materials, and that will start the process of building our product. Once the product's actually finished, it moves into finished goods. So period costs are not associated with the product. Oh, we've got a nice slide here to show you as well. So product costs include direct materials, direct labor, and manufacturing overhead. And one more time, just to reiterate here, we've got your direct materials plus your direct labor plus your manufacturing overhead. That's your total product cost. And those start out as inventory, and then we have to credit those and move them to a debit into cost of goods sold. And they will sit in until we actually, let me clarify here. So typically your inventory, all three of those categories, will sit as a debit in your inventory account. And then once you actually sell them, meaning they're finished and completed and you sell them, then it transfers as a credit from your inventory and debited into your cost of goods sold. Now, cost of goods sold here is an expense item, so we are transferring it from an asset into an expense. And I think that's what they're trying to say here. We're moving from the balance sheet, and then once we sell that inventory, it moves on to our income statement as an expense item. And then period costs, those are just expensed as incurred. So real quickly, let's review those costs. So product costs are going to be all the costs involved in acquiring or making a product. And again, your direct materials, direct labor, and manufacturing overhead. And then the period costs are those selling costs and administrative costs. Those are expensed on the income statement in the period when incurred. Okay, let's do a couple more little quick checks. So which of the following costs would be considered a period rather than a product cost in a manufacturing company? A, B, C, or D or E there would be considered a period rather than a product cost. So remember, those are sales and administrative oriented. So the answer would be property taxes on the corporate headquarters, and the reason, if this would have been manufacturing facilities, it would have been considered product cost. But since that's headquarters, that's administration. And sales commissions, that's related to sales. Here's another question, and again, you may want to pause this. Determine whether the following costs should be product or period costs. And the answer is there. So manufacturing overhead is a product cost. It's associated with manufacturing a product. Selling expenses, selling and administrative are period costs. Advertising is part of a selling expense, so it's a period cost. And then direct labor and direct materials are product costs. Okay, now businesses can be classified as service, merchandising, or manufacturing companies. In the earlier financial accounting chapters of the text discuss service businesses and merchandisers. Now we're starting to be introducing you to manufacturing companies. So the three categories of businesses differ in what they offer to the customer. A service company offers its time, services, and knowledge for a fee. Merchandisers buy products from suppliers and then resell them to customers. And manufacturers produce goods by converting them from raw materials into a finished product. And in order to do this, the company must use labor, equipment, supplies, and facilities. Now, the largest expense for service companies is obviously salaries and wages. Now, for manufacturing and merchandising companies, cost of goods sold is typically their largest expense. So the cost of the merchandise that they're actually selling. Let's see. So service companies have no inventories. Merchandisers have one inventory account, which is merchandise inventory, and manufacturers have three different inventory accounts: raw materials, work in process, and finished goods. So raw materials inventory consists of materials used to make a product. We've discussed that already. So raw materials for a bakery would include flour, sugar, and eggs. Work in process inventory includes goods that have been started in the manufacturing process but are not yet complete. So for example, going back to the bakery example, bread dough ready for baking would be found in work in process. Now, finished goods inventory contains completed goods that have not been sold. So in a bakery, finished cakes or loaves of bread would be examples of finished inventory. Now, for businesses that provide a service, all the expenses are period costs. Merchandisers and manufacturers have some expenses that are period costs and some that are product costs.